you have an idea, you spent months developing it, you believe it's genuinely valuable and maybe even genuinely unique. You get a meeting with an investor, and before you share anything meaningful, you ask them to sign a non-disclosure agreement to keep what you're about to tell them confidential. They say no, and not just this investor, every investor you approach. Some politely, some dismissively, some with a look that makes you feel like you've just asked them something ridiculous. If you've been through this, you know how it feels. It can feel like arrogance, and it can also feel like the investor is saying, I don't respect your idea enough to protect it. Or even worse, it can feel like the investor is saying, I reserve the right to take your idea and give it to someone better. I want to tell you something important. The refusal has almost nothing to do with your idea. Instead, it is about how venture capital works as a business. And once you understand why, you will not only stop asking for NDAs, you will also understand something about the investor-founder relationship that will make you a sharper fundraiser. Now, the first thing I want to talk about is the volume problem. A serious venture capital fund sees hundreds and sometimes thousands of pitches every single year. A fund of any meaningful size can receive up to 2,000 inbound deal requests in a 12-month period and then take from 10 to 20 meetings per week across the partnership. Now, imagine signing an NDA with every founder who walks in through that door. You're now legally bound to thousands of confidentiality agreements covering thousands of business ideas, market pieces, business models, and technologies. Not only is the administrative burden paralyzing, the legal exposure is even far worse. Because here is what happens next. The same fund is also talking to your competitors. Not because they are conspiring against you, but because in any active market, multiple founders are working on similar problems at the same time. If a VC has signed an NDA with 5 founders building in the same space and then goes on to invest in one of them, the rest of the 4 now have a potential legal claim. Was the investor exposed to confidential information from one founder that influenced their decision to back another founder? Even if the answer to that question is no, proving that it is indeed no requires expensive litigation. No serious fund will accept that legal liability. So the NDA refusal is legal risk management and not a comment on the value of your idea. There is a second reason that is less obvious but equally important, and this has to do with how a venture portfolio works. A VC fund is not a single investor making one investment at a time. It's a portfolio business. The fund manager is managing 20 and sometimes 30 companies at the same time. And those companies, especially if it's a VC fund that is focused on a specific thesis, will often overlap on the market, the technology, and even the customer segment. For instance, a VC company that is investing in fintech infrastructure is going to back multiple companies that are in some sense operating in adjacent spaces. They'll talk to all of them and they will share insights across the portfolio where it is appropriate. They also make introductions and they see patterns across companies that the founders cannot see from inside their own business. Now, an NDA will break this model entirely. If a VC signed an NDA with every portfolio company across every prospective investment, they cannot have these cross-portfolio conversations that make them a genuinely valuable investor. That information flow that creates value for founders is the same information flow that an NDA would restrict. You need to stop looking at investors as just a check. They are a key part of an information network. NDAs cut the connection that makes that network valuable. So here is the thing that most founders do not want to hear but genuinely need to understand. Your idea is almost certainly not unique. And I do not say that to be dismissive. I say that because it is statistically almost always true. The VC you're pitching has most likely seen 3 variations of your idea this very year. Maybe not identical, but similar enough that an NDA would create the exact kind of legal exposure I described earlier. And most importantly, your idea is not your asset. Your execution is. Your team is. The specific insight about a specific customer in a specific market that you've developed through lived experience, that is what investors are evaluating. None of that is in a pitch deck and none of that is captured by an NDA. The things that make your business defensible are actually the things that cannot be easily replicated, and those are not things that an NDA protects. The founders who ask for an NDA are usually the ones that believe that the idea is a competitive advantage, while the founders who win are the ones who usually understand that the idea is the starting point and execution is everything. And you know what? Investors can see the difference immediately. Also, the NDA request, ironically, can sometimes be a signal that the founder has not quite grasped how the investing game works. So you may be wondering, if NDAs are off the table, how do you protect yourself in investor conversations? And it's quite practical. First, control what you share and when. You don't need to disclose everything in the first meeting. Share enough to create genuine interest. You can save the most technical details and proprietary data for later in the due diligence process after you've assessed the investor's seriousness and character. The pitch is not the due diligence. You're allowed to be selective about sequencing. Secondly, do your checks on the investor also. Talk to founders they've previously backed. Ask specifically how they handled information. Also ask if they've ever invested in a competitor to an existing portfolio company without disclosure. An investor's reputation for integrity is actually more protective than an NDA because reputation is one thing they cannot afford to lose. Third, understand what exactly is actually protectable. Technical innovations that meet the criteria can be patented. Proprietary data sets are protectable as trade secrets. Specific processes and systems can be documented and protected. Build the legal infrastructure around the things that genuinely warrant legal protection, not the high-level concept of your business. And fourth, always remember that timing matters more than secrecy. Your most dangerous competitor is not an investor who heard your pitch. It's a well-funded team that can execute faster than you. The best protection around that is moving quickly and building customer relationships that are difficult to displace. Speed is a better moat than an NDA. This video is part of The Raise, which is my series on the real mechanics of raising capital. If you like this video, subscribe and I'll see you in the next one.